Now guys, this video is one of the ones that you should watch all the way to the end, especially because a lot of what we're talking about, I'm gonna get to my point right at the end of the video, but let's talk about this real quick. Let's assume you have $100,000 cash, you graduate college, you got a 9-to-5 job, you've been working for earned income or active income, trading time for checks for years, you've done the right thing, you've saved up enough money, and you're realizing you can't hit your goals through what you're trying to do with your finances through just working your job. You now understand that you have to do something outside yourself, and you're looking to build equity and cash flow and get into real estate. So on the board behind me, we're gonna assume that this is you. You have $100,000 to invest and you're looking at getting into real estate. But the question is, do I take that $100,000 and buy one rental property free and clear and leave all my money tied up in that one house? Or do I take that $100,000 and chop it up into small little amounts, $20,000 a piece, and buy 5 rental properties and use the bank to debt leverage and put loans on the properties to leverage myself out to own more real estate? So what's the best way to go? We're gonna look at this from a couple different angles here. I'm gonna give you my opinion, then you decide what you wanna do with your own business, because most people are gonna say 100%, let's leave them in their debt leverage. We can own more houses, we can build more cash flow, but it also depends on how well you know the business and what you do with the money and other types of strategies. So I'm gonna go through this really quickly. Obviously guys, yes, I did put this together myself. Bear with me here, it's about midnight and I put in a 16-hour day. If only you guys knew what went on behind the scenes to create this for you guys. You know, coming in here, bear with me. I know these numbers are kind of scribbled on here, but guys, let's look at this closely. Good thing is it's YouTube, you can watch it multiple times. So here's the house that we're gonna use for example purposes. All in, $100,000 all in, ARV $125,000, so you have $25,000 in equity. When I mean all in, everything, all your costs total are all in on this deal. It's gonna rent for $1,200. Your total PIT or your debt service to own the property, principal, insurance, taxes, and interest, you're gonna have $847 total. Now those numbers are gonna vary a little bit for your market probably because you're gonna have different taxes for the tax valuation of property, etc. But we're only gonna play with tight ranges that are gonna hopefully affect most, or hopefully be closely resembling what you're doing within your market, I guess I could say. Okay, so your total cost is $847 to own it. Let's over here assume the first example, guys, then we're gonna go to the second example of all cash, but this first one's debt leverage. You're gonna buy 5 houses with that $100,000. You're gonna leave $20,000 in each deal. As you get better, you're gonna leave less money in each deal, and as you get really good at finding deals, you're actually gonna get a check when you go back to refinance. So, but for this example, we're gonna assume you're a brand new investor or someone who's just kind of figuring out the cash flow game, $20,000 each deal. Now, if you had $100,000 to start, 100,000 divided by 20,000 is 5 houses. So you're gonna build this little portfolio here of 5 houses. Now, how's that gonna cash flow for you? Rent $1,200, total cost $847, your monthly cash flow is $353. If you take that by 12 months, you're making $4,236 a year. Now we're gonna throw out some other costs, guys, like vacancy and repair costs. We're just looking at PIT. We're just using this for example purposes. Now, let's say you had 5 houses by $4,236. You have $21,180. That's a really good cash flow. 21,000 into 100,000 is 21+% cash on cash return on your money. That's pretty good, right? I think a lot of people would think that's pretty good. Okay, now is there a better way to do it, or should we do it differently? Here's the other option. Some people who don't go through the training process to understand that you can use leverage to own real estate, buy a house with all their money and leave their money in it, and this is what it would look like to do that. You leave all $100,000 cash in the property, it's free and clear. You don't have these two parts of your payment up here. You're just paying taxes and insurance now because you own the property free and clear. $325 a month. Your rent is $1,200 minus $325 for taxes and insurance. $875 cash flow by 12 months is $10,500 a year. So if you look at the difference between 5 houses leveraged with bank loans versus leaving your cash in, $21,000, $180 for cash flow versus $10,500. It's over doubled. I believe that's right. Yeah, 10,500 plus times 2 is 21,000. So it's over doubled. So why would anybody want to do this? Okay, first off, I want to share something with you guys. If you don't realize, the market's slowing in a lot of markets around the country, and people who went out of business in the last crash spent years building 30, 40, 50 rentals, and they leveraged them too highly. And when the market turned by 25, 30%, they were negative equity. People started losing their jobs. They couldn't pay the rent. They were behind on their bills. And all of a sudden they have all these properties they're taking back, or that they're having to get re-rented. They have repairs they're putting into it. They didn't keep enough cash in reserves. Now they're negative equity. They don't even want to keep them. Before they know it, they lose their whole portfolio and they're out of business. You cannot lose your house over here if it's free and clear. You never hear about anybody going out of business if their house is free and clear, but you do if they stay highly leveraged all the time. Okay, just to keep that in your thought process. Now here's where this gets interesting, because when you own a house free and clear, you have equity in that house, right? So let's assume over here, we go and get a credit line against the equity in this house. We find someone that wants to loan us a credit line or give us credit against the property. What can you do with that money? You can take that money and you can re-lend that money. You can use it as a hard money loan, be a hard money lender, 2 and 12, 3 and 14, whatever your market is. You can take that money, you can go buy another property similar to this, fix it up and go back and go to the bank and cash out refi. You can cycle your money. You can also flip a house. You can take that money with the credit line, use that to instantly have the speed to close on a property, close on it quickly so you get a good deal. Then you go flip that house, or you can just take all this extra money in the credit line and use it to run your business for marketing and other things within your business to get more deals. Because if you take that money and you generate 5 more deals through marketing, you're making more money, right? But let me just give you an idea of one little case study down here to show you how fluid money goes and how you can cycle it and grow faster if you know what you're doing. So you can take this money, credit line against this property, you buy this house for $50,000, you put $30,000 in carrying costs, closing costs, etc. So you're all in for $80,000. Then you sell it for $120,000, a $40K profit minus closing costs, right? Now most people are flipping houses between 20 and 50 grand depending on which market. Some markets are a little bit higher end, but it's pretty safe to say you're gonna make between 20 and 50 grand. Now why I wanna show this to you is, let's say most people can do a flip between 4 and 6 months. So let's use conservative numbers. Let's say that you just netted $35,000 on a house and you did this two times a year. That's $35,000 plus $35,000, $70,000 extra coming into your account. Now you're $10,500 plus $70,000. Now you're $80,500, which is a lot more than $21,180, right? So what is that, like 60,000 more, something like that? So here's what you gotta also look at. This is the last kicker. So yes, you can cycle this money and make more money by turning it over quickly, but a lot of people are screaming at the screen right now, at least the ones that know what we're talking about getting into this. They're gonna point out, well, you have 5 houses over here, and the equity amount up here is the difference between 125 and 100. So you have 125,000 in paper equity as compared to one house where you only have $25,000 in equity. So there's an extra $100,000 in equity. Okay, but you also gotta understand this, guys. When you talk to people out there, they all want to assume that they're doing better than they are. So a lot of people tell you I'm a millionaire, I have a net worth of $1 million because of all their assets. They're talking about pro forma numbers. If you truly were to liquidate this, that's not really 25 grand that you're gonna put in your pocket. You're gonna have to put a little bit of money in the property to sell it. You're gonna have concessions, you're gonna have carrying costs, you're gonna have extra closing costs, you know, and if you're not using a flat fee shop or you're paying a 6% real estate commission, this can shrink quite a bit. So I would say that 100K in equity is gonna shrink really to 40, 50, 60, 70K, depending on how efficient you are and how much money you actually have to put in the property by the time you go to sell them. So that being said, you guys are gonna have to play around with these numbers and see what's the best way to go. Now this, I believe, is the best strategy when the market's exploding going up, because the market's increasing. This can actually go up. But what happens if this starts going down over the next couple of years and drops by 20%, which is very, very likely to happen in a lot of markets? You just have to understand, go back and study the history of what happened in the last recession to kind of give you an idea. So here, you cannot take this money out and play with this money to create more money. Over here, you can. So if you can cycle it more, plus you're not as big a risk headed into the crash because you're not highly leveraged on all these properties. So it's just a couple different ways to look at this. You're gonna have to play around with your own numbers and decide what you wanna do. But if you think your market's turning and going down, leveraging all these properties may not be that good of a decision to do right now unless you're able to go get those really, really low interest rates right now and lock in some long-term loans, which may be the best play. So which one is right? I don't know, guys. I want your opinions on this because you're gonna hear a lot of people argue it one way or the other way. I've actually done both, so it's up to you guys. Tell me what you think, put your comments below. Let me know what you thought about this video. If you haven't already done so, subscribe to the channel, guys, support us, help us grow. Like the video, share the videos around, I'd be grateful for that. And I will see you on the next video, guys. Have a good day.